Thank you for taking a few minutes from your busy day to watch a brief video. This one is going to focus on the best tax tips for business owners, specifically those who are considering hybrid long-term care insurance. My name is Jesse Sloan. I'm director of the American Association for Long-Term Care Insurance for a little over 25 years. We've been here advocating the importance of this protection, supporting insurance professionals who market long-term care insurance, and consumers, of course. If you get value from this video, would you do me a personal favor and click the like button on YouTube? That will tell others that they should consider spending a few minutes watching it. Thank you. So, first, I want to preface it by saying the association does not give tax advice. For that, you should talk to your CPA, your financial professional. But I want to spend a few minutes giving you an overview and some specific tips and advice that you don't readily see everywhere. So a lot's written about the tax advantages for business owners who are considering long-term care protection, long-term care insurance. The thing you need to know is, depending on how your business is set up, if you're a C Corp, you have the maximum, benefits in terms of tax deductibility, because 100% of the premium can be tax deductible as a business expense. For yourself as the owner, for employees, you can even set up carve-out groups so that you can include and exclude specific parts of the company. If you're a pass-through entity, or you're self-employed, or you're an individual, there are tax deductible benefits, but they're generally based on the age-based limits, and you should learn more about that. So continuing with the quick overview, hybrid products, as you probably know by now, are a combination. They're a linked benefit product. They're a combination of a life insurance policy with a long-term care rider. The life insurance portion of the policy, where you're going to have premiums assigned or connected with the life insurance benefit, that portion is going to be treated as a compensation bonus to the recipient. It is 100% tax deductible to the business, but it's 100% taxable to the employee as compensation received. And we're going to talk about, one of the tips: designing these policies can help you maximize the tax deductibility to the business and minimize the taxable compensation to the employee. The long-term care premiums, that part of the hybrid product, that's treated as payments for an accident or health plan. So again, they are tax deductible to the business. They are excluded from the employee's income. So there's no taxation. That's a key benefit and something you want to keep in mind. And of course, with any long-term care, if it's a tax qualified plan, any of the benefits received ultimately when the policyholder needs claims are received tax-free. Now, here are a couple of quick tips. First, all hybrid long-term care policies are not equal in terms of cost, not equal in terms of potential benefits. And as this slide will show you, they are not equal in terms of what the IRS considers tax qualified for potential deductibility. And what you need to look more into are the differences between the IRS regulation 7702B versus 101G. We have a lot of that on the association's website, but it's really important that before you sign on the dotted line, you ask your advisor which IRS regulation this plan follows. Is it a 7702B, or is it a 101G, which is a chronic illness rider? The second tip is each insurance company decides how they want to file their policy, the contract, and how they do that can maximize the potential deductible amount for you. So as we said, life insurance premiums are not tax deductible, but the long-term care riders are. And so some companies just glop all the long-term care riders into one pool, and maybe they limit it. Others have figured out creative ways to create multiple divisions within the policy contract, so that you can have an inflation rider that now becomes tax deductible, an extension of benefits rider. All of those things give you the opportunity to have greater tax deductibility. Third tip, got the small pot of gold and the big pot of gold. If you're looking for the bigger pot of gold in terms of maximizing the potential tax deductibility amount, well, how your advisor ultimately designs your policy, providing they're utilizing these provisions that the company has put into the policy. And that sounds complex, but the bottom line is how you design the policy can help you maximize the potential deductible amount. So for example, you could start with a smaller life insurance benefit, but if the policy enables the inflation rider to be tax deductible, well, you could maximize the inflation rider. What does that do for you? One, when you're likely to need benefits, you have a huge pool of benefits available to you. And when you're looking for the tax deduction, you can get that maximum tax deduction. Other ways to do it are have limited pay policies where you pay them off over a period of 5 years. So if you're 60 and considering retiring at 65, you buy a policy that you have the whole thing paid off by the business by the time you're ready to retire. Those are some tips. And if the financial advisor you're working with is not sharing those tips with you, well, then maybe it's time to consider comparing with an expert in the business. The association doesn't sell long-term care insurance, but we can definitely hook you up with a hybrid long-term care insurance specialist who can educate you, help you design a policy that will get you the maximum coverage and maximum benefits. Just give us a call at 818-597-3227, 818-597-3227. And again, if you got value from this video, I personally would appreciate if you'd click on the like button. And also, if you want to learn more, visit the association website, www.aaltci.org/hybrid. We have a lot of information up there that I know will benefit you. Thanks for taking the time to watch.